Alrighty. So in today's video, we are going to be talking about a pretty hotly debated topic, well, at least on some of my videos, and that is on stop losses on options. Well, do they actually help or do they actually harm your trading performance? So this is one of the topics that I see newer traders like to debate on, right? Mainly because they've just transitioned from the outright trading world, where they are trading outright stocks, and then they place a stop loss. So when they come to trading options, they also try and transfer this concept of stop losses onto options. So do they actually work or not? So let's dive right into this. So today I'm going to share with you quite a number of data, research, and studies. So, it will be pretty deep. And hopefully we can put an end to this debate once and for all. So if you come from the traditional world of outright stock trading, buy, sell shares, then you would be very used to having a stop loss, because having a stop loss is important to manage your risk and not have any single trade blow up your account. But what about when it comes to trading options? Does it make sense to have a stop loss? And does stop loss actually work the same way as it would in options as in outright trading, right? So for this, we want to lean on data, research, and all the studies that I've already done to make a more informed decision, right? The last thing we want is to pull out the idea, out of the thin air, or let's just pull it out of our ass, and think that we are right. Like anything in life, when we are making any decisions, whether you realize it or not, sometimes you are really already relying on statistics, right? On data, right? Let's say, for example, whenever you buy any food, sometimes you will turn around to the packaging and you want to see, what are the ingredients, or whether, there are any harmful stuff inside there, right? Like, for example, trans fat, right? Trans fat, many years ago, we have no idea what that is. But as more studies come out, we found out that trans fat actually, increases health risk in our body, right? Like, for example, it increases the risk of having a heart attack or stroke. So that is why, when it comes to buying food, we want to try and avoid eating, any food that has trans fat, because the data, the research, the statistics have already proven that it's bad for our health, right, in the long term. So when it comes to trading options, it's the same way as well. We want to lean on the data research to make an informed decision rather than, just believe that our own thinking is right. So this is where you want to unlearn everything that you have already learned from the traditional world of, outright trading, buy, sell stocks, and then now just open up your mind and take a look at some research which is specifically regarding options. So this is the long-term performance of the Strangle. So this is a study again by the Tasty Trade team, and they have done many research and studies on this. And what they did is they compared managing losers to holding to expiration. And what they found is that holding to expiration actually gives a better result, a better return than managing losers, right? So as you can see down here, the managing losers is 2x. What it just means is 2 times the credit which you receive, right? So for example, if you sold this Strangle for $1 and then you buy it back for $3, what happens now is your losses, okay, this is a 3, so your losses will be $2, okay? So this is a dollar sign, pardon my drawing. So what it means is that per contract, the max profit that you can make on this would be $100, because that's the credit you receive. And because of your stop loss at 2x, your losses will be $200, okay? So this is how they measure these studies down here. This is how they do their studies. Now, this is for the Strangle. You might be asking, Davis, what about the other strategies, right? So again, this is for the short put, right? This is for the 16 delta short put. And again, as you can see down here, holding to expiration is much more effective, right? The results are better than if you were to have a stop loss. So again, this stop loss, I believe, is at 2x as well. Now, while at the earlier stages, right, let's say right after the crash, somewhere around 2009, going into 2010, right, managing losers might have a better result, right? But this is pretty short-lived, right? Because in a number of years' time, you can see overall, holding to expiration is just going to outperform, having stop losses. So yes, stop losses, you're still going to be profitable, but hey, if you already just held to expiration, you would be even more profitable. So in this case, there's no point for you to actually have a stop loss. Now, you might be thinking to yourself, hey, Davis, this is undefined risk, right? Undefined risk. What about defined risk strategies like credit spreads and iron condors? And I'm glad you asked, because here are the studies, right? So this is for credit spreads. So I believe this is the put spread. So again, they have tested, the $5 wide put spread and the $10 wide put spread. And as you can see, holding to expiration again has better performance than, if you were to cut your losers at 2x the premium which you receive. Same thing for $10 wide spread. Again, holding to expiration is much better than cutting losses, right? Having a stop loss. Now, what about Iron Condor? And again, Iron Condor is the same as well. If you hold all the way to expiration, you can see your results are still much better than, whatever multiple losses that you plan to cut off at. You can see they have 1x all the way to 5x. That means if you sell at $1, for this 1x loser, you're cutting off at $2. And 5x losers, basically you're cutting off at $6. And in all instances, holding to expiration is still much better than if you were to have stop losses, right? So as you can see, this is a very common theme amongst all the different strategies. So we can really just see from here, the data has already shown, the statistics have already proven to us that over the long term, holding to expiration will already have a better result than if you were to actively manage it and then have stop losses. So if stop losses are not as effective in managing risk, and we don't want to hold to expiration, mainly because, we do not want to have the risk of early assignment and then possibly having to face a margin call, what can we do to manage risk more effectively and get better results? So if you have already seen a number of my videos or you've been a follower of my channel for quite some time, then you probably already know what I'm about to say, right? And the answer, in terms of managing risk in trading options, exiting at 21 DTE is much more effective than having a stop loss. And again, I'm not just pulling this out of the thin air. I want to lean on research, data, statistics, right? There's a reason why I say exit at 21 DTE is much better, because there is evidence to support this. So again, as you can see down here, this is the statistics, the data, research, study, whatever you want to call it, has been already done. And this is on the strangle. As you can see, we already know that holding to expiration is going to be far more effective than having a stop loss, right? The results are going to be better. But if you were to exit at 21 DTE, guess what? Your results are going to be even better than holding to expiration, which means to say it's going to be even far better than if you have a stop loss. All right. Now, this is for the strangle. What about for the other strategies? Well, this is for the naked put, all right, the short put, the 16 delta put. So as you can see, exiting at 21 DTE, again, better than holding to expiration. For credit spread, same thing as well, right? 21 DTE is still better than if you were to hold to expiration. And again, that means far better than having a stop loss. And again, for Iron Condor, same thing as well. If you were to exit at 21 DTE, you're going to have a much better result than holding to expiration. So there is another table I want to show you, which is far more interesting as to why this is so, right? Because it's very puzzling. Why is it that holding to 21 DTE and even holding to expiration is even better than if you will have a stop loss, right? Because this is something a lot of new traders just cannot grasp. Why is this so? So if you were to take a look at this table down here, it actually shows some very, very interesting data, right? Some interesting research that they have shown. So down here, you can see these are the number of losers where you cut off, right? Basically where you employ your stop loss. And this tells you, how many losers you would have incurred based on cutting off at, the various multiples, right? Based on your stop loss. And this is the number of losers you would incur if you actually exit at 21 DTE. Or earlier than 21 DTE. So you can see that if you were to cut off at 1x the credit which you receive, you're going to have 28 losers. But if you were to exit at 21 DTE, right, maybe even earlier, you only have 12 losers. And if you go to, 2x your losers, then you would have 14 number of losers. But when it comes to 21 DTE or earlier, you actually have 4 losers. And as you can see, it goes all the way to the extreme. If it goes to 5x, you notice that you actually have 2 losers. But when it comes to exiting at 21 DTE, 4x and 5x losers, actually there isn't any at all. Which means to say, if you were to exit at 21 DTE, you actually do not sustain that big of a loss compared to if you would have stop losses. So this table down here is even more interesting because they went into even more details, right? They went in depth to find out how many of those losers actually became a winner, right, by closing at 21 DTE or earlier. So if you were to exit at 1x the credit which you receive, you can see that you have 12 losers. But if you were to exit at 21 DTE, 11 of those losers that you close out actually came back and become a winner, right? They actually became a profit. And if you were to cut off at 2x and 3x, you can see that at 2x and 3x, you will have losers, right? 4 losers for 2x, 1 loser for 3x. But then if you were to exit at 21 DTE or earlier, then guess what? All those trades actually eventually came back and became a winner, right? So this again is very, very puzzling for a lot of new traders. And I'm going to explain why this is so, why some of these trades actually came back to become a winner. And it's not necessarily because the market actually bounced back, although that could be one of the reasons. But another of the reason is something that options have and outright trading don't. Right, and I'm going to share this with you. So why is having a stop loss on options ineffective? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Well, the main reason is because options have a mechanism that outright trading don't, and that is theta decay. Theta decay just means that over time, the position, right, if it doesn't move, it can become more profitable, right? Because as you can see down here, this is the purple line. This purple line down here shows you your P&L graph at the point when you first put on the trade, right? So this is a put spread. And the green line down here is where it's at expiration. Now, over time, this purple line will start to move towards this green line and becomes this green line at expiration. Which means to say, let's say, for example, if the market actually trades down here, and then you tell yourself, hey, it has already hit my stop loss of, let's say, $50, I'm going to get out of this position. Well, you may have gotten out a little prematurely, because if the market didn't move and time just went by, then guess what? This position is actually going to become profitable. Now, there's another way where a lot of new traders use stop losses, and that is when it actually hits their short strike down here, right? So this will be your short strike of the put spread, -1 put. This is where the long strike is, +1 put, right? So this is where you have your bull put spread. So many traders, new traders that is, they want to employ the stop loss at where the short put is. That means if the market was to trade down here, this is where they are going to cut their losses. But this is actually not very effective when it comes to options, and this is the reason why. One thing down here you need to look at is the probability of touch. So the probability of touch is a statistic that will let us know, what's the percentage of it actually touching that strike price at any time before expiration, right? So for example, if you have a 30 delta short put for your put spread, it just means you have roughly 70% win rate, right? So this is at expiration. So you have a 70% win rate on your put spread, which is actually pretty good, right? This is what many traders want to strive for. They want to have a pretty high win rate when it comes to having a put spread. So 30 deltas, I would say, is pretty good. A good mix of premium as well as, win rate. Now, 30 deltas also mean another thing, right? It also means that it has a 30% chance of being in the money at expiration. But more importantly, when it comes to stop losses, you want to use probability of touch, which it means to say that it has a 60% chance of being touched, being breached at any time before expiration, right? So if you decide to exit your position whenever your short strike gets breached, then guess what? 60% of the time, you will be stopped out, right? So whenever the price drops down here, you're going to cut your loss. Most part of it is likely going to be a loss, because 60% of the time you're going to cut your losses. So that is why having a stop loss on options is not going to be that effective compared to if you were to trade outright trading. So based on all these statistics, research, and data that we've already seen, we can conclude that having stop losses is actually not as effective when it comes to options trading, and it's much better to just exit at 21 DTE. Now, inevitably, whenever I show, any of this data, research, and studies that have, pretty strong conclusion that stop losses is not effective, there will always still be some people that will reach out to me and then tell me, something like, hey, Davis, What if I'm still not convinced that stop losses are ineffective for trading options, and I still think that stop losses will help reduce my risk when trading options? I still think that stop losses is going to get me better results because I've used it in outright trading, and I think that it's going to work in options trading as well. So I'm not convinced that, the data that you've just shown me, the studies that you've just shown me is actually true, right? Maybe because you're using stop losses differently, right? You might say that, hey, I use stop losses differently, right? I don't cut off at a multiple, I cut off in terms of a dollar amount, right? Let's say maybe at $50 I want to cut off the position, or at $100 I want to cut it off. Or maybe you say that your stop losses is based on technical analysis, right? I cut off my positions when it breaches the stop loss or when it breaches the resistance, right? If you're one of those guys in this camp where you're saying this, then here's my answer to you. So if despite all the studies and research that I've already shown you that shows that stop losses are no better than holding to expiration, and in fact exiting at 21 DTE will yield you a better result compared to holding to expiration or even using stop loss, and you still want to use stop losses because you think you have a different idea on it, then guess what? Go ahead, right? Just go ahead. I mean, after all, this is your money, this is your life. Why do you want to let a bunch of PhDs who does options quantitative analysis for a living and also trade themselves, right? So they practice what they preach. Why should you let them tell you what you should or shouldn't do with your own money? After all, it is your money, right? So you should bear the responsibility of what should happen to your funds, if you choose to trade it the way that you want to. So if you really still want to use stop losses, and on a more serious note, then you definitely want to test out your ideas over 100 plus trades and then compare it to exiting at 21 DTE and then see if your results are actually better, right? There's no point talking or commenting on my YouTube channel, say, hey Davis, what if I just put a stop loss at $50 loss? What if I place a stop loss when when the support is broken? Well, instead of just telling me all this and just pulling out the idea out of thin air, actually test it out, right? Test it out, but of course do this on a demo account instead of a live account, right? Because if you actually found out that your stop losses, your usage of stop losses actually is going to be better, then you actually do want to go ahead and use stop losses instead of exiting at 21 DTE based on all the research that I've shown you down here. And if your results actually prove that the Tasty Trade research team's analysis, right, all the studies that they have done are wrong, or maybe they have missed out on certain part of the studies on stop losses, whereby you have found an effective way to put on stop losses that is better than 21 DTE, then please let me know. I really love to know about this because I would even create a video on this, right? But until then, until you have actually found out a way to prove that stop losses is actually better for the rest of us, please just lean onto the data and research that's already been shown, already been done for us. All right. So at the end of the day, I've already shown you all this data, studies, research. Do stop losses on options actually help or harm your trading performance? You've seen all the research, all the data, all the studies. Now you decide for yourself. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.